All right, this is the DeFi Podcast, the first podcast on decentralized finance. I'm your host, Karim Sabba, and together we'll delve into the decentralized finance ecosystem, or DeFi for short. DeFi is actually one of the most exciting developments within the blockchain space. Up until now, the traditional financial system has created enormous amounts of wealth for the happy few, meaning people and organizations who had access to the resources and knowledge necessary to be at the big boys table. But since the boom of blockchain, countless projects may emerge to try and rebalance the global access to basic financial services, such as transferring value, lending, or insurance. Now, DeFi has flourished to include stable coins, decentralized exchanges, marketplaces, new investment products. The list goes on and on. Today, I have the pleasure of welcoming David Fauchier, CEO of Cambrial. Hey, David, how are you?
Very good. Thanks for having me.
Of course. Thank you for coming. So let's get right in. You launched a fund of funds, meaning that you invest in funds that themselves invest in the digital asset space. One might say that such products should arise only when you have I would say a mature ecosystem, right? So like in the traditional asset management industry, there are literally tens of thousands of funds in the world. So you do need someone to guide you in this mess. But in crypto, there aren't that many active funds to begin with. So maybe can you give us, to start, an overview of the field? What's your estimate for the number of active funds and assets managed as of today? And most importantly, why do you think at this stage a fund of funds makes sense?
Yeah, absolutely. So funds of funds have existed. The very first hedge fund came out in the late 60s, run by a guy called Alfred Jones. And he actually ended up turning his hedge fund into a fund of funds in his later life, when there were not very many hedge funds around. Today, we've got about 7,000 hedge funds and a lot of funds of hedge funds. About 50% of the capital in those is in a hedge fund is typically from a fund of funds or a fund of funds like platform. I think with crypto, the arithmetic is a little bit different. I think the approach that LPs that we speak to take is this is an asset class that we want to get some kind of exposure to, but we understand very little about it, and we are not comfortable taking those risks ourselves. So can we ask another entity to go out and basically select hedge fund managers and crypto funds for them? And so you get these cycles in the history of fund of funds in different asset classes, in VC, in hedge funds, and I think in crypto over the next 10 or 20 years, we're going to see the same thing, the same cycle replay itself, which is that a new asset class comes out and people start getting interested in it. They want exposure, but they don't know how. And so they turn to a professional allocator in that space to do it for them. And they look to funds of funds to do all of the kind of crypto specific due diligence of selecting a fund. And also to, if you select one fund of funds, that fund of funds is going to diversify you across a number of different underlying crypto funds. And so you get both the diversification and the selection that get sort of outsourced to that fund of funds you've chosen. And so the history of funds of funds is very much that they start with where the main service being provided is just selection of which funds to invest in. Over time, as the winners become apparent, those funds typically close. And so hedge funds morph in their more mature stage into access vehicles. So if you think of venture capital, you could build the best fund-to-fund portfolios in the world right now very easily. You'd say, well, I'm going to get some Andreessen Horowitz and some Sequoia and some Benchmark and some USV. The problem is that you don't have access to those vehicles. And so you have this transition between the early stage when it's really about providing selection and expertise into one in a more mature cycle where it's very much just about getting access. And so if we look at crypto specifically, a lot of the risks are actually operational and a lot of the opportunities are quite transient because the market structure is changing very quickly. And so strategies that worked 2 years ago, like inter-exchange arb, are not working today, and a new set of strategies are working. And when you're a fund of funds, you can sort of hover above and go out and find managers that are incredibly good at particular strategies that are very attractive right now and may not be in 1 or 2 years. So it gives you a little bit more flexibility.
Okay, super interesting. So the job is actually very fundamentally different from investing in the assets or other companies. What do you look for when you meet a new investment team? What do you look for in a team and in the structure or the strategies?
I think when I talk to venture capitalists, it's always quite surprising how similar our jobs are. A VC is going to go out and meet with a ton of startups, and they're going to be looking for an incredible founding team who have an incredible idea and are executing very well on that. With what we do, it's not that dissimilar. We're looking for extraordinarily competent founding teams who've got prior experience in the strategy that they're running, who are people that we can trust with our money, who are going to be good stewards of capital, who have a high sense of integrity, and who are sort of genuinely world-class at whatever investment strategy it is that they're pursuing. And so one of the things we look for very much is integrity, a fair alignment with a good alignment with the LPs, a fair fee structure, etc. And then the sort of second most important thing after that is, are these guys truly the very best at this strategy that they're pursuing? And is that strategy an attractive one in the market? So you could be very, very good at doing something, but that something is not a very good opportunity in the market, versus being very good or the best at a particular thing, and that opportunity representing a sort of attractive area of the market in which to make money. And so we're looking for good managers who are excellent at what they do and are working in interesting areas of the market, very much like picking a startup.
Okay, great. We'll get into the market in a bit, but before that, I'd like to understand something that I think is fascinating about fund of funds. It's that is there anything that you learn by investing in only funds that you wouldn't by investing directly in the underlying assets or companies?
Oh, that's a good question. I think your view of the market is very different. The more time we spend with funds, the less time we spend reading white papers, to put it crudely. And so our level of or our depth of understanding for any single strategy is always going to be less than the manager we're speaking to. On the other hand, we get a much more horizontal view of the market. If you imagine speaking to 20 or 30 funds in a week and asking them all the same questions. What do you think about the market? What do you think about this particular event? Where are you looking for opportunity? Where do you see the market headed? Et cetera, et cetera. You get this very sort of horizontal cut across really the largest allocators in the space at a point in time. And I think that's a very interesting view that you can't get otherwise. This sort of what is globally the world of asset management in crypto thinking at any point in time.
Yeah, exactly. Basically, at any given time, you know what make investors tick. For instance, like a few years ago, maybe 2013, 2015, the big thing was exchanges, right? Like, so funds like Pantera got in a lot of exchanges very early. They made a killing. How about now? What do you see funds looking for right now?
So our focus is very much on market neutral strategies, which is to say funds that are trading much more actively but are not taking a direction in the market. So markets go up, markets go down. Ideally, they continue to make money. And what these strategies will do is equivalence of arbitrage. So buying an asset in one place and selling it in another at around the same time for different prices. So buy low, sell high, or the reverse. That's sort of a very simplistic way of thinking about what market neutral is. Pantera, I think, did a fantastic job in having a very strong thesis and sticking to it for a very long time from very early. So I remember having conversations with Dan Moorhead when they were raising their Venture Fund 2. This was in 2013 or 14, who runs Pantera. And there was this discussion that no one had really found an answer to as to how was value going to sort of accrue in the system. Was it going to be to the picks and shovel businesses like exchanges or to the assets themselves. And they genuinely went and they said, we're going to bet on both. And I think they very much deserve to have gotten some fantastic returns on the venture fund and on the Bitcoin fund for having held those opinions for so long and seeing them actually turn out to be correct. And I think what Pantera was doing in 2014-15 is exactly what is overcrowded today, which is all of these picks and shovel businesses, which are very sort of hygienic ways to bet on crypto without actually touching cryptocurrencies. And so you don't need to buy tokens. You don't need to get into the regulatory mess. You can just go and invest in the latest on-chain analytics startup or exchange, et cetera, et cetera. And so I think we're in a position where all the capital in the world is able to invest in those businesses, and a very small amount of capital is able to actually invest in crypto directly. And so we're seeing that manifest itself in the valuations. And so all of these kind of picks and shovel businesses that anyone can invest in are being invested in at valuations that are much less attractive than what they were when Pantera was doing it. And so I think what we see today is a continuation of investing in picks and shovels because there's a lot of demand from institutions for that. We see a lot more sophisticated investment into tokens directly. So the conversation over 2017 really shifted from, I think, a pretty unsophisticated view of how these assets might accrue value over time to some really interesting discussions, debates, and experiments in token economic model design. And so I think people have gotten a lot more thoughtful about that. And so we're seeing a lot more, I think, thoughtful investments in crypto assets directly, with really a view on the economic side of it. And then finally, we're seeing a lot of money just into Bitcoin because it's sort of a very clear value proposition as a store of value and a hedge against global instability. And so there's these three, I think, very different parallel flows of capital that are coming into crypto. One of them into the picks and shovel businesses, one of them into really through some leading VCs into actual projects and crypto assets. And that's very much gone into DeFi, which we can get onto. And then the third one has just been very much Bitcoin centric.
Okay, got it. And so would you say that there's a correlation between like volatility and prices of the overall market like of Bitcoin, Ether, and so on, and the funding trends in equity in startups?
When crypto goes up, it's positive for the ecosystem. If it's positive for the ecosystem, then building infrastructure around that ecosystem is more attractive. But I think that the reasons why people are investing in infrastructure companies versus tokens directly have a lot more to do with LPA restrictions. So on what investors are allowed to invest in and what their LPs will let them invest into, and regulations. Then the people investing in crypto assets directly is sort of the inverse problem. It's quote unquote more democratic in the sense that pretty much anyone can go out and buy Aragon and they can invest a couple pounds into that and they can speculate on what Aragon's going to do and how they're going to deliver value over the next 10 years. The issue there is the willingness and the ability to actually do sophisticated analysis on that. So much more democratic, but ultimately I don't know if the result will be any better. And I think the parallel people should look to for that is stocks. Anyone can, in many countries, anyone can set up a brokerage account and buy and sell stocks, but the average retail investor has underperformed the market. Yeah.
Okay, got it. So you did mention that a lot of the funding is actually going to DeFi right now. Let's dive in this a bit. What's your or Cambrial the definition of DeFi?
We think of the DeFi space quite broadly. I guess DeFi as a concept has only really been around for about a year. And the name came up when there was a Telegram group to organize the first DeFi Summit in San Francisco, and they were trying to figure out a hashtag for that. And that was sort of it. And so you can think of it as decentralized finance or as open finance, but fundamentally it's how do you provide financial-like products and services using decentralized protocols and smart contracts. And so because of its origins, which was very much, decentralized finance projects on top of Ethereum, it is related to that, and people think of it in those terms. And certainly most of the DeFi projects are based on Ethereum. But you could argue that the very first DeFi app was Bitcoin, which is decentralized money. So it's not a very, I think, rigid definition, and I don't think anyone really owns it. But it's broadly just financial products using protocols.
Yeah, definitely. We can at least agree on that. And because of most of those like new products and services actually existed before, right? Just on a different infrastructure. I think we're going to see some big, and we are already seeing some big overlap, right? Between the traditional world and the blockchain world. And this is definitely going to create some friction, maybe even some bigger organizations like banks or regulators will try to shut down what's being done right now. From your experience, like how do you envision the cohabitation of DeFi and non-DeFi products?
It's a tricky question, I think, because clearly a lot of the DeFi products that are on offer today would constitute regulated activities in most countries, except that they're being done on a protocol and it's not clear who has governance over that. And so the view that regulators and governments have taken over time, for example, with Bitcoin, has been to say this actually slots quite well into existing laws. And so we're going to classify Bitcoin as property or a commodity or a security or whatever it is, and everyone can follow those rules. The issue with DeFi is no one really knows where to fit it in, and that happened with Bitcoin a few years ago, and they found a new sort of choke point, which was the on and off ramps between fiat and crypto, and those are the ones that are getting very heavily regulated. I think we'll see something happen similar in the DeFi space. There will be a new choke point which regulators will be able to exercise control over, and they will. I don't think that DeFi is going to be this sort of unregulated nirvana where everyone comes and transacts. I think that we're going to see one of two things, or I guess one of three things happen. The first is that the DeFi space sort of fights back and refuses to be regulated, and it would be possible to do that, but you would have an equivalent of the dark web, and so it would be used by a very small number of people who are going to great lengths and potentially danger to use the service, and so they're not going to do it unless they have a very good reason to. And by the way, there'll be great sort of centralized and regulated alternatives which you could use, and so it could stay a very small, very niche part of the I guess internet stack, and be used mostly for illegal purposes. That's option one. Option two, which I think is the most likely, is that we will have two parallel systems. It makes sense for it's very difficult to think about how machine-to-machine payments or how smart contracts can interact with each other, or how you can have proper decentralization without trust, when you also need to have regulatory oversight and approval and safeguards and KYC, et cetera, et cetera. And so I think it's difficult to see how these systems converge without DeFi itself becoming denatured in terms of what it's trying to achieve. And so I think we'll see sort of two parallel systems where the DeFi space will very much be about, it'll almost be an API layer for value and financial transfer, but you could see markets forming in non-security assets and machine-to-machine payments happening over that, et cetera, et cetera. And then we'll have a sort of thriving normal, quote-unquote normal crypto economy happening in a centralized fashion through normal exchanges. So I think option two is very much these two parallel worlds, which will be allowed to coexist. And the third is where they sort of merge. And that I think is very difficult without, like I said, denaturing what DeFi is trying to achieve.
Okay, interesting. Within the DeFi ecosystem, I think we can agree that there are dozens of projects right now working on the same problem. So let's take, for instance, lending and borrowing platforms. There are at least, I think, 10 live platforms providing this service. Do you think that within within DeFi, we're going to see a concentration of all of those projects? And who do you think will get the whole pie? Will it be the biggest network, the biggest product, the best product? How can we work this?
So, in terms of concentration, the sort of value locked up in DeFi about a month or two ago at about $700 million. It's now at about 500. There's really 5 meaningful DeFi projects at the moment in terms of volume, and Maker is like 60-70% of that, and Compound is 20. Uniswap is 5, and you've got a couple others. But so it's very much concentrated in Maker. I think that we don't have a clear view on who's going to win, but I think some of the very important vectors will be, first of all, liquidity, second of all, longevity, because when you're locking up value in DeFi, you are taking a large amount of contract risk, smart contract risk, and you want to see a system that's been operating bug-free for a while with a large amount of value in it before you want to trust it. So the second one is longevity. And the liquidity, which is number one, is really because you need liquidity for these things to function, for a sort of frictionless system where value can move around and things can be entered and exited at very low costs. You need a lot of liquidity in the system for the spreads to come down. So liquidity, longevity, I think, are really the two main things. And then the third one will be around UX, or whatever UX looks like for protocols. I think we saw a dramatic capture of the market by Compound, which doesn't necessarily have a better product, but it's just easier. It matches up the counterparties for you. You just deposit collateral on Compound and you get a return. And it's much easier than, or it's one level easier than other options. And so they did very well and it became very popular. And so I think these 3 vectors, liquidity and longevity and UX, are going to be the key sort of defining ways in which protocols can win. And I think because liquidity is so important, we will probably see winner-take-all type economics in most of the verticals in DeFi.
Yeah, interesting. Thanks a lot. Another interesting trend in your world is generalized mining. So first off, the name, I think, can be a bit confusing as if I understood it well. This is not just about running nodes, right? Can you expand on what generalized mining or mining 2.0 is?
Yeah, absolutely. So a lot of people call it very different things. We put out a piece on generalized mining in November and ran an event around that, around DevCon in Prague. I think you can sort of think, and this is an idea that we poached from CoinFund, who are some of the best thinkers in this space, we think. So shout out to them. But you can sort of think of mining as a continuum. And on one end of the spectrum, you've got basically, let's call it Bitcoin mining. It's SHA-256, it's hardware only, it's very much binary. You're either mining or you're not. And it's sort of like you buy the chip, you plug electricity in, and you make money. And you can sort of move down the curve from that sort of very simple, very almost mechanical mining towards staking and the different types of staking systems, custodial, non-custodial, etc. There are different ways of staking and validating. And then you can sort of keep moving down the spectrum to other forms of work which can be provisioned on crypto networks. And this is the idea of interacting directly with a blockchain and producing work and getting paid for that. And you can very simplistically think of, a Bitcoin miner is interacting with the network in the sense that they are providing security to the state or the Bitcoin blockchain. And you can go all the way out to the other end of the spectrum and think of a protocol like a live peer, in which you have these participants in the network which are providing services to the network in the form of video transcoding, and they're getting paid by the network for providing that service. Or you can think of Filecoin, in which a storage miner is storing files in exchange for money. And that for us is the more interesting side of generalized mining, this sort of third bucket at the extreme, where you're interacting directly with protocols and provisioning network services for cash, basically, or you are interacting in some other way, like you're providing liquidity on a particular network, like Lightning for layer 2, or you are people have experimented with front-running Steam bots. We've seen DEX arbitrage, different forms of liquidity provision, etc. So there's lots of different ways of interacting with protocols in order to produce some kind of a profit. And that's really how we define it very broadly. And then we've zoomed into sort of each of these three areas. So one of them being very much, proof of work hardware mining. And we think that's a space ultimately that will be centralized in the sense that everyone will be buying the same chips from the same top 3 manufacturers. And then in terms of the sort of staking type services, we've seen a number of those come out since November and gain some traction. But ultimately, for us, that looks very much like a savings account. People will custody their coins, or in a non-custodial way, allow people to stake using their coins. And they will get some kind of a revenue stream from that. Ultimately, I think because it's relatively passive and relatively easy, the returns on that are going to come down to, something that looks like a bond. It just pays out, 3, 5, or 7%, whatever it is. Yeah. And that'll be that. And I think the staking businesses will use that as an opportunity as a sort of platform on which they'll build other products. Sort of like how a bank provides you with a current account, but then it has all of these other products like home loans and credit cards that they upsell you with. I think that'll be the future sort of 10 years out for staking services. And then the third area was the one that was interesting for us as a fund of funds, because it was very much this trader-like interaction with blockchains, providing more sophisticated services which are not binary. So this idea of, you're either mining or you're not. But actually, if you look at LivePeer, the quality of your transcoding matters. Uptime matters. There are things that you can do in software to optimize your rate of return. And that, I think, is where the sort of generalized mining and even the DeFi world start to touch this sort of Venn diagram of quants and quantitative funds. These are very much similar skill sets. It's just applied in a wildly different universe, which is, on-chain. And that's very different for most people, but the ideas are very much the same to traditional quant. And we think that's a relatively interesting area if you're looking narrowly at just opportunities for investment managers. That's interesting. For the space as a whole, the way we see crypto playing out is that there's a number of different sort of super themes or macro themes that you might look at. One of those is money and programmatic money. There are a couple others, but the one that's interesting for generalized mining is this idea of sort of public services or utilities that get integrated directly into the backbone of the internet. So that today, the way we do certification is through a centralized certification authority, but you could have it that a number of different internet-like services are provisioned over the internet across decentralized protocols by anyone and to anyone. And that, I think, this sort of massive interaction with blockchains in order to provide services over the internet, I think that's where generalized mining, where the promise of it is, and where it will go. And over the last sort of 9 months since we wrote that piece, there's not been a huge amount of change. I think we've been a little bit disappointed by adoption. DeFi and really Maker has been the only thing that's sort of broken out in terms of adoption. And on the generalized mining piece, you really are dependent on millions of people using a particular product for that to really kick off. But I think it will. I think that these consensus mechanisms that we created 10 years ago are fundamentally useful for provisioning services in a massively scalable way across networks of people that do not know or trust each other. And so at some point, this is going to pick up, but there's just not been much progress recently.
Okay, so basically, what we are seeing is that you yourself, or I mean, your portfolio funds, since you're a fund of fund, those guys are basically aligning or trying to align their interests with their portfolio companies. I think that even the term portfolio companies can be a bit obsolete right now, given the new framework that we're in. But that's basically the idea, right? Or is there something even more, meaning that the investors want to be actively participating in the development of the project, helping them when they're early stage and so on?
Yeah, so we've seen a lot of and this makes sense, the sort of VC type funds actively getting involved in the networks that they're investing in, either from a governance perspective or actually provisioning the network. It depends on the fund, but I think the point of view there is, I think Kyle Samani put it very well from Multicoin. He said the best way to generate alpha is to create it. And so if as a fund you can make an investment and then you can invest operationally yourself into nurturing a particular network and growing it, then the value of your investment will grow as well. And so that's a good thing. And so we're seeing funds get much more active in helping and nurturing and growing the networks in which they invest into. I think that's a trend that will continue. If you take this to the extreme, you could imagine funds that only do generalized mining. And this is something that we've thought about and we're sort of waiting to see. I think today there's a number of people that are thinking about doing it. But number one, it's very difficult to raise assets for because no one understands what you're doing in terms of the average LP. This is way over their head. And secondly, because there just aren't that many projects for you to go and get involved with where you could deploy a significant amount of capital into. So it's still a little bit too early, but I think it will come.
Because of the amount of resources and energy that you need to deploy to participate in the early life of a project. I mean, you need to have a lot of deal flow, and I guess maybe you can give me your opinion on this, but I guess most of the deal flow pitched to crypto VCs or crypto funds, they actually do not go through with it, and most of the markets doesn't fit, I would say, the investor's requirement, right?
Yeah, that's true of everything, I guess. But it's very difficult to be a fund that has, the thing with a fund is that you take a little bit of the profits and a little bit of the assets under management, and then you have to pay a whole team and do a whole bunch of regulatory things, and so it's all quite expensive. And so typically it doesn't make sense for a fund to have less than 20 million of assets under management at a very, very minimum. In the traditional world, it's more like 300 for a normal hedge fund. And so with 20 million, how would you go and deploy that in just generalized mining? It would be a really big challenge because there aren't that many projects that you can go and deploy that kind of money or resources into, because it's still a very small space. And so what we see in the interim is the people doing, I guess the investors doing the most generalized mining are VCs that are helping their portfolio companies. I think that's great.
Okay, and one thing that I was wondering about is that when the network does get bigger, how can the fund let everybody, the community, take over to ensure actual decentralization? Is there a phase-out plan or something that looks like this?
If you need to have a phase-out plan, I think you failed in designing your incentives, because ultimately a fund will live or die by its performance, and these funds are, rightly or wrongly, focused on generating performance over time. And I think the way some of these funds have looked at it is, we'll be there on day one providing services on the network, and allowing it to actually function for anyone who wants to try and make it work. We'll release a lot of the work that we've done open source to help other people provision services on the network. And gradually over time, because it's an interesting economic opportunity, other people will start doing it naturally. And therefore, we will get diluted out over time, not because we're willing to give it up, but because the network itself is growing and we're just one small fund. I think that if you design it properly, that's how it should work.
Okay, interesting. Well, we'll say that how that plays out, I guess. Before we hang out, let's talk a bit about the DeFi Summit. David, your firm, Cambrial, is, correct me if I'm wrong, but organizing the next DeFi Summit, co-organizing the next DeFi Summit in London, right, on September 10, 11.
Yes.
Can you tell us what we can expect?
Yeah, we're definitely co-organizing it. DeFi is very much a sort of decentralized group of people that know each other, respect each other's work, who sort of come together and we decide on a location and run an event there, and everyone chips in a little bit. It's really a sort of a wonderful. It's wonderful to see because it's very rare, and so very much community. It'll be in London, so we have been helping out a lot because that's where we're from. It's happening on the 10th and 11th of September. We opened up speaker applications about 3 or 4 weeks ago. And so we've got 50 confirmed speakers and a couple panels and demos. I think it's going to be a lot of the best kind of crowd in DeFi flying into London, which is great to see, and just sharing ideas. And so, yeah, we are open if anyone wants to make a submission for a talk. They're welcome to do so on the website, which is DeFi Summit. But the last 2 letters, the I and the T, is a dot, so defisum.it. And then we've got about 350 spots for attendees. I think we've got quite a few registrations already and can still accommodate some more. So you have to submit an application and it gets handpicked by the organizers. And so what we're really trying to do is maximize high quality, kind of multidisciplinary interactions between people, rather than get as many people as we can in the room. And so it's going to be a mix of academics, of founders in the crypto space, some regulators, some institutional service providers, investors, people working in fintech, economists. It should be a really interesting group of people. And what we've tried to do a lot in this DeFi Summit has been to try and put the spotlight on some of the smaller emerging projects that are very interesting, but people might not have heard about.
Okay, interesting. And there were actually previous editions, right? Like in SF and Prague. Have you seen any major change, like within the event, within, I don't know, like the crowd, the topics over the last few years?
I wasn't. Someone else on our team, I think, was at the SF one, but I wasn't. And I was in Prague, which we helped out with a little bit as well. So I actually don't have a good frame of reference. I think the types of people that we come across in the DeFi space are broadly similar. There has been more traditional finance people coming in, which has been good. If you're trying to do things like issue debt or build an exchange, it's useful to have people who understand how the best markets operate or how people underwrite credit in the real world. It's very useful for that. And so we've been seeing, I think, over the last year, a real blending of hardcore tech and ideas with some real world experience. And it's allowed for a lot more sophistication, I think, in terms of the products being built.
Okay, awesome. And last question, why do you think we need to increase interest in DeFi, and how can people actually contribute?
DeFi is I think, very interesting, if only that it gives people a second option from what they have today. And for some people, they have fantastic options in terms of managing their finances, investing, holding value. And for others, they don't. And so I think it's important that we have alternatives, even if those alternatives aren't as good. Maybe not as good a UX, or more expensive, or more slow, more clunky, whatever you want. But it's always important to have an alternative. And I think DeFi very much fills that role and is an enabler for a lot of different product services that we want to build and deliver over crypto networks on a sort of 10, 20-year time horizon. So I think it's very important to nurture it, to grow it, to invest in it, to improve it. And so it's great to see so many teams in that space. And there's some great reading that we can maybe post in the link.
Yeah,
if people are interested in diving in. And we'd love to see anyone come to London for DeFi Summit on the 10th and 11th of September.
Awesome. Well, all right. Thank you very much, David, for your time. I hope everybody appreciated your insight. If you want to know more about what David is doing, go to cambrial.com. Also, check out the DeFi Summit on September 10-11 in London. Do you have anything to add, David? Where can people find you or get in touch with you?
I think that's enough.
Yeah. Okay, good. Well, that's it for today. If you like the show, go to DeFiPodcast.com for more episodes and follow Woorton, the Woorton on Twitter and LinkedIn for highlights and more content on the decentralized finance ecosystem. Thank you very much for listening and see you soon.